everyone, myself Dr. Priyanka GHOSH from Department of Commerce, Krishna Jayanti University. Today we are going to talk about valuation of goodwill. So before starting the valuation of goodwill, first we will just discuss about what is the definition. So goodwill, as we know, it is the brand value or the reputation of the company. And goodwill is an intangible asset, it is not a tangible asset. And it is a real asset, and goodwill always exists with the business. So if business is there, goodwill or brand value will be there. Otherwise, the goodwill will not be existing. So next we will discuss about what are the methods of goodwill we are having. So basically we are having 4 methods. So first one is average profit methods, then capitalization method, super profit method, and annuity. So in this session, we are going to talk about the super profit and capitalization. So before going to in depth of the calculation, first we will see what are the methods and steps we are having. So if you can see where we are considering the 2 methods, super profit and capitalization. So till step 5, the formulas and the steps are same. Only during the step 6, we need to utilize different formulas to calculate the goodwill. So first step, we are going to talk about the adjusted profit. Now what is this adjusted profit? So sometime what will happen when we are calculating the profit, some of the adjustments are not happening, like the manager's salary or the insurance premium paid. So if this kind of any expenses are not being adjusted with the profit, first we need to adjust with our profit, and then we can calculate the adjusted profit. So after calculating the adjusted profit, next we should go with the average profit. Now, if you want to calculate the average profit, we are having 2 methods. One is simple average, another one is weighted average. So here, after calculating the adjusted profit, we need to see what is the trend of the profit. So if the profit, the fluctuations trends is there, then we should go ahead with the simple average. But if in the profit is having the increasing trend, then obviously we should go with the weighted average profit. After calculating the average profit, next step we are going to calculate the average capital employed. So average capital employed is having one formula. We need to consider the fixed asset plus current asset minus current liabilities. Then we will be getting the total capital employed. From there, we need to minus the half of the current year's adjusted profit to get the average capital employed. So after step 3, we should go ahead with the step 4, where we need to calculate the normal profit. So normal profit equal to, it is average capital employed into normal rate of return. In step 5, we are going to calculate the super profit. So in super profit formula is average profit minus normal profit. Now at the last, we need to calculate the goodwill, which is the step 6. So here we are using 2 methods, so 2 different formulas should come. So in case of super profit method, we need to multiply the super profit into number of years of purchase. And in case of capitalization method, the formula will be super profit divided by normal rate of return into 100. So by using these 2 formula, we need to find out the value of goodwill. So let's see one example. This is one example I have chosen. So you can see from the following particulars, compute the value of goodwill on the basis of 3 years purchase of super profit. So here you can check the number of years of purchase is given 3. And we need to take the average of last 4 years profit. Again, along with the super profit, we need to calculate the goodwill also based on the capitalization of super profit. Fixed asset, current asset and current liabilities values are given. Normal rate of return is 10%. There is only one adjustment, managerial remuneration if employed elsewhere, that is 10,000 per annum. So that adjustment we need to do against our profit, and last 4 years profit we have given. Now according to the step wise, we will calculate step wise and then we can proceed with the last step. So as per the format, first step we need to calculate the adjusted profit. So here you can see, look into the question, we are having only one adjustment, that is a managerial salary. So what is the meaning of that? Meaning is that the manager's salary, there was a manager but the salary has not been adjusted with the profit, that is a 10,000 per annum, and manager's salary is our business expenses. So any kind of business expenses, we need to minus it from our respective profits. So here you can see in step 1 I have written 4 years profit, and from each year's profit I have deducted managerial salary. So I received the adjusted profit. So first year it is 1 lakh, second year 1,10,000, third year 90,000 and fourth year it is 1,30,000. So this is the first step, adjusted profit we have calculated. Now before going to step 2, we need to find out what is the trend of the profit. So if you can look into the adjusted profit, you can see there is a fluctuation, 1 lakh, 1,10,000, then 90,000, then 1,30,000. So from this fluctuation trend, we can easily understand that we need to follow the simple average profit. So if we want to follow the simple average profit, the formula is total adjusted profit divided by number of years. So if you can look into the step 2, I have added all the profits and divided by number of year is 4. So we got the simple average profit is 1,07,500. Next, step 3, we need to calculate the average capital employed. So when we are going to calculate the average capital employed, first we need to start with the fixed asset. So fixed asset here, if the market value is given into the question, we should go with the market value. If market value is not given, then directly we can consider the balance sheet value. So here fixed asset value as per the question 9,50,000. With that we have added current asset, that is 90,000, and total asset we received 10,40,000. From there we have deducted current liability, that is 1,50,000. So we got total capital employed at the end is 8,90,000. So from total capital employed, we need to minus half of the current year's adjusted profit. Now current year's profit means here we are going to talk about the fourth year or the last year profit. So last year, as per the step 1, last year profit is 1,30,000. So 1,30,000 half is 65,000 we need to minus, and we have to calculate the average capital employed, that is 8,25,000. Next, step 4, we are going to calculate the normal profit. So formula is average capital employed that we have calculated in last step into normal rate of return. So normal rate of return, it is already given into the question 10%. So 8,25,000 into 10%. My normal profit is coming 82,500. So after calculating the normal profit, we need to proceed with the super profit. So super profit formula is average profit minus normal profit. So average profit we calculated in step 2. So step 2, as per the step 2, average profit is 1,07,500 minus 82,500 is my normal profit. So super profit is coming 25,000. Last step, we need to calculate the goodwill. So we are having two methods. One is super profit and capitalization. We have to use the formula and we need to calculate the goodwill. So if you are following the super profit method, the formula is super profit into number of year of purchase. So super profit 25,000 we got, and number of year of purchase, it is already mentioned into the question itself. So it is 3 years. So 25,000 into 3, my value of goodwill is coming 75,000. If we are going for the next method, capitalization method, my formula is super profit divided by normal rate of return into 100. So super profit we got same, that is 25,000, and normal rate of return it is given, it is 10%. So my goodwill is coming 2,50,000. So in this session we have discussed the definition of goodwill, different methods of goodwill, and how we can calculate the goodwill under super profit and capitalization method. Thank you all. Next session we will discuss with another interesting topic and with another practical problem. Thank you.